This has been a really interesting stretch over the past 6 years for retirement funds, investors all across the country. We have seen a very difficult recession that impacted individuals, the economy, and certainly the financial markets. And then we also have seen a tremendous involvement by the Federal Reserve and central banks around the world in effort to bring about a recovery both in the financial markets and also the Main Street economy at large. And happily, the county's pension fund and the majority of pension funds within the Commonwealth have seen their funding ratios improve as a result of the strong performance that the markets have experienced in both equities and bonds. One of the things that we are focused on at CS McKee is maintaining a discipline in how your portfolio is constructed, keeping in mind that even though the markets have been up now for 6+ years in a row, that there may be a correction at some point, and that when stocks and bonds don't always go up, it's important to have good fundamental valuation in your portfolio and a high margin of safety to maximize the county's interest and the plan participants' interest in those scenarios. There are two items, the first of which, anytime there's a material change in the portfolio team that is managing the county's account, it is our obligation as a co-fiduciary to your plan to notify you of the change. We're very pleased to announce an excellent addition to our equity team, a gentleman named Dr. Harish Iyer. Dr. Iyer has a degree in biomedical engineering, background at Rensselaer Polytech and also Case Western Reserve University. Early in his career, he developed a device that is a pacemaker, a diaphragm pacemaker, which is to assist individuals who have had severe spinal injuries. Dr. Iyer's background in the healthcare sector, we feel, is a tremendous asset to our clients, as he will be covering the healthcare sector of the stock market. One of the things that we pride ourselves on is the stability that we've been able to put together in our investment team, where the average tenure with CS McKee is over a decade, and the average industry experience is about 23 years. So you have a really seasoned group of professionals that are handling this portfolio day to day. One of the things that I'd like to talk about a little bit is the performance in the plan. The portfolio's asset allocation has served it well. Being tilted more heavily towards equities has benefited the absolute return in the fund, as bonds have underperformed stocks over this period where you've had this allocation tilt. That being said, we think that 2015 is going to be a little bit more of an eventful year in fixed income, because on everyone's mind is the question of when will the Federal Reserve start to move interest rates. And the market has already begun to front run that to some degree, with the 10-year Treasury moving up from about 1.63% to about 2.25% today. The 30-year mortgage has crept back up in the range of around 4%. So as those interest rates start to rise, it means a couple of different things for the county retirement fund. First of all, it's good for new money that we're investing in bonds. As rates go up, the county's able to get a better return on those bond investments that we're making in the future. For existing positions, it can be a challenge, because if we were to go out and say buy a 10-year Treasury bond today at 2.25%, or say we bought some in January when it was yielding around 1.63, as rates go up, your bond that pays you 1.6 is less attractive, because now the market is at a higher level. And not many investors realize this, but there is more risk in owning a longer-term bond as rates rise than shorter-term bonds. You might recall that early in 2014, a change was made in the bond portfolio of the county retirement fund. The portfolio had been at what was called an aggregate duration strategy, which meant that your average bond had a duration of about 6 years. We shifted that to an intermediate strategy, and it was something that I spoke about with Mike and with Brett extensively, because the view was that it would be better for the county to have a shorter duration portfolio to protect some of the gains that have been made should rates start to rise. Rates didn't move anywhere really in 2014. In fact, the Wall Street Journal's survey of economists predicted that rates would go up. Every economist to a man said rates would go up, and every single one was wrong. In fact, we at CS McKee were wrong in our prediction as well. Reasons include Ukraine and weaker than expected economy in Europe and a number of other considerations. But long story short, rates are starting to move up now in 2015. And that change that was made in your portfolio is benefiting right now. If rates continue to rise, the county will be better off than had we not made this change. And it also gives us as your investment manager greater flexibility to reposition into higher yielding bonds as rates start to move. So we appreciate the board authorizing that change. We appreciate the counsel from the team at Stifel and assisting us with that. Talk about the equity portfolio. One of the things that is raised a lot in our industry nowadays is the debate of active management versus passive. Why should we have an actively managed portfolio when index funds as a group have been beating active management as a group over the past several years? It's a really great question. It depends on what time period you look at, and I think to categorically say that one is better than the other is a trap to go into, because depending on what time frame you look at, one may outperform the other. If you're looking at this period where quantitative easing has been in place, quantitative easing has had a disproportionate benefit to companies that have had to borrow more money relative to the total size of their business. If you think about it, it makes perfect sense, because if you have a business that really needs to go to the credit markets and borrow a lot, when interest rates are really low, that's more favorable for your company and your stock. But as interest rates start to go up, you have more challenges perhaps than a company that likes to carry a lot more cash on the books. If you look at the 14-year period from 2001 up until the end of 2014, our benchmark, the Russell 1000 value, ranked in about the 80th percentile of all the investment strategies that you could consider. The strategy that we manage for Lebanon County ranked in the 21st percentile over that period. We were a good active manager over the last 14 years. In fact, the median active manager beat the Russell 1000 value by over 100 basis points during that period. So we still believe in active management, but it's difficult for active management to outperform, A, when the market does nothing but go up for the last 6 years, and B, when there are a lot of companies that we won't own that an index fund will, that have received a disproportionate benefit, we believe, from very low rates. We're not going to own a company that has borrowed 100% of its value. That won't screen in our process. But we will own companies like Intel or Microsoft, companies that are maybe more boring firms in the tech sector, but really good generators of strong cash flow, and companies that we think have a better outlook than the market is giving them credit for. I'm pleased to report that for the year to date, both of the asset classes that we manage for the county are ahead of their benchmark. Through market close on May 19th, the county's investments in fixed income were up 1.18% versus 0.88% for the benchmark. And in large cap value, the county's portfolio was up 3.59% versus 2.26% for the Russell 1000 value. It's not a coincidence to us that our performance improvement versus the benchmark is coinciding with this move up in interest rates. And we believe that the conditions are favorable to active management as rates start to return to normalcy and as the Fed has ended quantitative.
Would it be wrong to assume that as the rates continue to improve, that will have an impact to reduce our ARC?
As interest rates go up, that can benefit the portfolio. The way that actuarial liabilities are calculated, it does take into account interest rates. And so in the same way that in commercial real estate, if a cap rate is really low, say the cap rate is 4%, the value of the property will be significantly higher than if the cap rate were 6 or 8 or some other number. There's no question in our minds that as interest rates go up, it should benefit pension plans. It should benefit you in terms of your actuarial calculation. And it should benefit you also as investors, because right now, bond returns have been better than they probably should have been. If interest rates hadn't kept falling, then fixed income returns would not have been at the level that you've seen. And as an example, if you turn to the second tab of the CS McKee book, and the second page of this book, it's an overview of the county's bond portfolio that we manage. In the top left box, there is an item that is said is yield to maturity. The average yield to maturity of the Barclays Intermediate Aggregate Index is 1.59% over the next 3.8 years. That's essentially the over-under on the bond portfolio for the next 3.8 years, is about 1.6%. Difficult. If your actuarial math is used to bonds doing 5 or 6, and now the market is saying bonds are going to do 1.5 or 2, maybe they'll even be flat or negative if rates move up too quickly, that's really difficult. So we would like to see those yields get back up to a point that's more consistent with traditional pension math. The transition might be a little rocky, but by tilting your portfolio heavier towards equities and having that real estate exposure, the county's investment portfolio overall is helping to mitigate some of that transition. And I think it's important. You know, we've gotten the question, why don't we just put all of our money in stocks? If bonds aren't doing anything, why don't we just put the whole thing in equity? Well, that would be great if you knew the market was going to go up, but if it goes down, then you're really going to be unhappy with that result. So, it's a heavy task for your consultants at Stifel to try to balance that need for return with appropriate management of risk. And I think that you've given us at CS McKee and the folks at Stifel good tools to help manage that risk in the portfolio. But it's going to be a tough environment for bonds, and there's no real magic bullet. You can buy longer term bonds, just like a longer CD will give you more yield than a shorter one. You can do that, but then you're locked in. And if rates go up, then you might not be happy. You can take more risk. You can buy corporate bonds in companies that are junk rated. I can tell you that the average default rate for high yield bonds has been closer to 5 or 6% over the long term than the 2% or so that it's been for the last few years. It's not a coincidence that when the Federal Reserve is saying, hey, we want to help stabilize the market, and we want to keep rates really low, the default rates have declined. Without the Fed's involvement, it's going to be a more traditional sort of environment for those securities. So you can take more risk, you can do longer duration, or you can try to maintain flexibility in your portfolio, and instead of saying we're going to go one way or the other, you can be diversified. And that's probably the best approach and most consistent with the fiduciary duty of the board and its investment advisors.